Okay, this one's rather serious. Market volatility. Those are not two words that you want to hear strung together, especially if you're invested in the financial markets. You certainly don't want to hear them from analysts from inside the major banks. That's very concerning. And yet, it's exactly where we are. But it's where we are going that should have all of us, well, deeply concerned. A loss of 24%, possibly 26% in the S&P in 2023. Let's see where this is headed. Here we go. So to start, I want to be very, very clear. I am not offering financial advice. I'm not a financial services professional, nor would I make suggestions as to what you should do with your money. This is just for information and entertainment purposes only, and my opinion is just that, opinion. This video will be rather short. There's no reason for it to be overly long. There will be no fancy words or terms. It's just facts, figures, analysis, and that coming mostly from bankers, not even from me. The S&P right now is already in a bear market, and it has been for some time. That means it's retreating to hibernate. It's not good. It's not a bullish market where it's rushing ever forward. It's been in bear territory, as I mentioned, for a bit, and it'll likely not end until sometime in 2023, possibly late. That's not me saying this. That's Bank of America, Goldman Sachs, and several others, including Morgan Stanley. The S&P will likely sit at 4,000 at the end of the year. That's not uplifting news, to be sure. I'm sure everybody would like it to be headed the other direction, but that's where we stand. We are likely set for continued losses in, well, not just the S&P, but the NASDAQ and the Dow. And those losses will mount for some time, most likely, unless magically the inflation rate and the interest rates are roughly even. And even then, we have to get the energy policy back in line and stop relying on some super green pipe dream that's years before it's ready. And otherwise, we might be dealing with hyperinflation at some time in the near future. In Tuesday's Business Insider article, which is where we're going to start, the headline says it all. The stock market could fall 24% in 2023 as the Fed balance sheet reduction sparks liquidity risks in odd places. At least this is from Bank of America. That's quite the lengthy headline, but it's also troubling, terribly troubling. We had a bit of a phantom rally that started on Wednesday, and that rally was unsupported. Phantom rallies are unsupported by little more than hope. Just a few positive signs, but nothing concrete. And at the close of Thursday, despite a decent jump, Insider ran another concerning headline. The rally in stocks will trick investors into thinking the bear market is over. Still a case for the S&P 500 to fall another 26% next year. And that's from Morgan Stanley's Mike Wilson. That is a tick worse than what we heard on Tuesday, but it's not surprising. The trigger for this kind of a fall will be an earnings recession. There's no doubt that this is in the cards. Handwriting's on the wall, and you don't have to look any further than Disney, who is actually set for a couple of rough quarters to start this year, 2023. And the phantom rally that we're experiencing or did experience is driven by what's called a Fed pause. And again, this is according to Mike Wilson over at Morgan Stanley. It's possible to see market gains in the next few weeks, but look at what the corporations are doing as investors bet into them again. They're cutting back. You know, if you're following the channel, you've seen me do a bunch of stories on layoffs. And yeah, what does that tell you? These two things just don't compute. Now, to be more clear, and for the second time in this video, I'm going to say the same kind of thing. I'm not offering any advice here, not any advice of any kind. I'm not a financial services professional. I offer no guidance when it comes to these things. I'm simply reporting and commenting on what is happening and what's being written about. And I'm talking about what some of the experts are saying. That's it. Now, according to, again, Morgan Stanley's analyst Mike Wilson, corporate earnings are still 20% too high. That's not news. They are set to fall. Also, if inflation falls back to the norm of 2 to 3%, stocks will fall on weak profit margins. In other words, it looks like a lose-lose situation here. even as that's better for the economy, you and me overall. Having inflation fall like that is going to be bad news for businesses, or at least publicly traded entities. And if things go with the bear market model, a 26% drop from current levels would be in line with what all of these strategists are predicting. They're also finally using the word recession. It's about flipping time. It also seems likely that after the dust settles, we could be looking at an S&P low of around or under 3,600, dropping it another 400 from where it's projected to be at the end of this year. For more information on these matters, I would certainly refer you to consult with a professional in finance and to explore the couple of articles that we've been through here today. But we're to the part of the video where I ask you, what do you think? Do you see sunshine and rainbows ahead, or are you expecting dark, cloudy storms? Would you care to venture a guess on where the S&P value may be sometime in May of 2023? I think that'd be an interesting number to get. And is this even the kind of coverage that you would like to see here from time to time? Sometimes I feel like some of the things that interest me, very few people would be interested in. It's just, to me, this is part of being well informed with what's going on in our culture. But please feel free to utilize the comment section down below. We can have a little bit of a talk about this. Maybe we can get some input from some of our financial professionals out there and get their thoughts. With that, I'll tell you to support other independent creators here on the platform. There are some people who have a background in this. They're steeped in it. They do it professionally, and they are very good at analyzing situations. Got a few here that don't necessarily exercise those muscles as often as they should, like Valiant, Renegade, and a few others. So do check out those people. Give them the support that they deserve. Like, subscribe, share, comment. Those are all important things for all of them. And if you don't want to miss anything, please hit the bell up above. It's a lot of fun to engage when you get notifications about the things that are happening on our channels. There's a lot happening on many of our channels, including polls and stuff like that. And hopefully you're enjoying that type of interaction as well. And with that, be sure to take care of yourself, take care of others, wash your hands, of course, because it's good hygiene. And until next time, bye. And don't forget to check out my Rumble at rumble.com/CultureCasino. And don't forget to check out my Rumble at rumble.com/CultureCasino.
Thanks for visiting today. Be sure you're subscribed and hit that for alerts.
Yay!
Of course, like and share all of the videos that you can, as it helps with the algorithm. Have a great day.